our panel on perspectives in high-frequency trading. We heard Terry's paper earlier that provided a good academic intro to it. This was when Paul called me and asked me to organize this panel. He asked to organize a practitioner panel. So we're practitioners in various ways, including Amy from the SEC on the regulatory side, Dean Payton from the CME Group, Richard Gorlick from RGM Advisors, and Joe Goronsky from Rosenblatt Securities, and Peter Novich from Alston Trading. So I think we have an outstanding group here, and I'll tell you a little bit more about them in a bit. Before we get started, though, I'd like to just announce the winners of the paper prizes. Nero is pleased to sponsor the prizes this year for submissions. I think there was a really good group of papers, so clearly we hope that it was partly in response to that incentive, but we were very pleased, and we had the finance faculty at Notre Dame, as well as some of the folks at NERA read through them, and pleased to announce that our second place winner, which is an $1,000 award, goes to Or Shakar for her paper on exposing the exposed intermediation capacity in the credit default swap market. And the first place paper this year goes to paper co-authored with Gideon Sarr, Robert Bloomfeld, and Maureen O'Hara on hidden liquidity, some new light on dark trading that you'll hear tomorrow morning. Now, I don't have the checks with me, and that's because the people who actually write the checks said, well, what are their tax ID numbers? So I'll have to circle up with you guys afterwards, and you'll have to, we'll share that information. So congratulations. And Nero was very pleased to be invited to participate in this process. Mentioned our distinguished panelists here. Let me just give you a little bit background on them. To my left, your right, is Joe Goronsky, who's the president and chief operating officer of Rosenblatt Securities. Formerly was a securities attorney with Sullivan and Cromwell. Has also worked a number of positions in industry, and has been co-author or author of several published papers on equity market structure, and a leading lecturer, moderator, and panelist on the topic. And I know I first became familiar with Joe's work and Rosenblatt's work on a paper that they did, I guess it was 2009 now, on high-frequency trading. That was a very good, instructive review of industry practices, and very, very useful for anyone interested in this topic. Amy Edwards, who's to Joe's right, is the Assistant Director, the Office of Markets in the Division of Risk Strategy and Financial Innovation at the SEC. She has written extensively on market microstructure issues, been published widely, has done a lot of work on issues related to decimalization, fragmentation, short selling, limit order displays, specialist participation, and transparency, and has been at the SEC since 1997 and earned her PhD at The Ohio State University. To Amy's right is Dean Payton, who is the Managing Director and Deputy Chief Regulatory Officer at the CME Group in Chicago. He's had that role since 2009, and he's responsible for overseeing the CME Group's regulatory efforts for the exchange platforms that run the CME, CBOT, NYMEX, and COMEX markets. He's been performing this type of role in market surveillance and regulatory side for many years, starting at the Chicago Board of Trade in 1988, and he has his MBA from Northwestern University's Kellogg School. And to Dean's right is Richard Gorlick, the CEO of RGM Advisors, a trading firm that he co-founded in 2001 and is based in Austin, Texas. The company identifies scientific approaches and how to use computing power and automated trading strategies in multiple asset classes around the world. And he is also a member of the CFTC's Technical Advisory Committee that you heard Andre speak about earlier. And Richard has his degree from University of Pennsylvania, but also his law degree from Georgetown University Center, so he's back in Washington. And then to Richard's right is Peter Navich, who is with Alston Trading, which a firm he's been with since 2004. And Peter started his career there on the technical side of the business. He became the chief technology officer of Alston Trading in 2008. In 2011, he was named executive vice president, where he still stays close to the technology side of the business, but is now involved in everything ranging from regulatory concerns, business development, strategic decisions at the firm. So what I'd like to do is I've composed a list of questions that I'd like to throw open to the panelists to start a discussion. You are welcome to join in as well. I will give you a cue as to when we can do that. But let me start off with just some basic questions. And this one comes about because a couple of years ago, Forbes magazine interviewed several people in the trading space, trading area, asking them to give a definition of high-frequency trading. And there's probably 25 different people they surveyed, and they got 25 completely contradictory answers that went all over the place. And I'm just curious, in your view, what is high-frequency trading, and what things are included in that term? And maybe Peter, you want to take a crack at this to start off with?
Sure. I start with a litmus test of trading a lot, which seems very simple, but if you look at a lot of definitions people give you, rarely is trading actually even mentioned. There's a lot of order flow, but not much trading, or a lot of position, but not much trading. So I start with just, it has to be trading a lot. And I expand on that a bit. It is trading a lot at such levels that might not have been possible pre the technological advancements we've had since the markets went electronic. And as simple as that.
Anyone want to amplify or join in? Joe?
I'll jump in and also take a non-traditional approach and say what it is not, because today just about all, we come from a floor broker background originally. My firm started in 1979, and that was a very manual way of trading. And today, the bulk of our activity is algorithmic trading as well. So people, a lot of times in their definitions, talk about algorithmic trading, and it seems to get confused. Just about everyone implements their trading decisions today via algorithms. So that's not really distinct. What makes high-frequency trading distinct, I think Peter's definition, while somewhat casual, is sort of right on the money. It's about using high-capacity, low-latency systems to trade an awful lot. It's the type of thing when we have an institutional order, we're putting in an algorithm, whether it's a VWAP algorithm or whatever it is. Yeah, there may be an order that's released every minute, every 30 seconds, every couple of minutes, but it's not hundreds or thousands of orders in a matter of milliseconds, seconds that may then all be canceled and a new set of orders put in. It's a very big difference in terms of the sort of order of magnitude, I would say, that distinguishes it for me. And of course it does encompass a range of different strategies. I mean, even here in the papers, there are the liquidity taking strategies, like what I tend to associate with more stat-arb-like activity, which has existed for a long time. And then there's the liquidity providing strategies that has sort of replaced the market maker function that used to exist pre the technological revolution and pre-decimalization.
I'm sorry,
I was going to say, I would just say that, obviously there's a lot of talk in the industry, both on the security side and on the future side, where folks are trying to define high-frequency trading, and there's, they want to do that for certain types of regulatory purposes. And, I think if you look at Peter's definition or Joe's, what you really see there is that it's all relative, right? I mean, a lot is a relative term, right? It has different meanings in different markets and different products. And all these things are a continuum, whether we're talking about latency, right? There are people who are co-located who are fast. I mean, CME Group didn't have co-location until January of this year, but we certainly had high-frequency traders by Peter's definition prior to the time that we were co-located. Same if you're talking about volume or order flow or order to volume ratios. All of those are a continuum, and I don't think that there's an arbitrary place where you define it from a regulatory purpose. From our perspective, in terms of how we think about regulation, we do differentiate automated trading from non-automated trading, but trying to specifically bucket high frequency is, in a sense, somewhat arbitrary.
Yeah, I just want to add one other little distinction, and that is, I think people try to talk about them as a group and as types of trading firms, but the problem is, take someone like Night Trading, find they have an agency business that looks pretty similar to what I do for a living, but their market making business, when you take out the pink sheet component that they do, when you talk about the liquid stocks that they trade in, they look no different than a GetGo. Maybe GetGo is better at it than they are, but they do the same thing. They have to have extremely high cancellation rates because they're constantly making their markets and changing their markets. After all, they're 13 market centers, displayed market centers, never mind the dark pool. So it's a lot of it is a function of the way our market structure has changed. But trying to name participants, I think, is particularly difficult. And some of these definitions probably are going to end up catching. Goldman Sachs has a old, specialist unit on the floor of the stock exchange. So for that component of their business and other proprietary components of the business, they're probably high-frequency traders, but they have very diverse businesses.
Okay.
Can I add one?
Absolutely.
I'm just going to add a couple elements, and of course I'm going to give the same disclaimer as Bert did, that I'm just speaking for myself, not on behalf of anybody at the SEC, but I think also one additional element is the short-term nature of the strategies. These strategies are very short-term. We're talking high-frequency trading is definitely within a day. I think you'll probably find a lot of consistency around that part of the definition. And also, these strategies tend to be technical in nature. They're more technical trading rules as opposed to fundamental trading strategies. The fundamental trading strategies tend to last a lot longer. A lot of them do use algorithms, but that's more of the longer-term algorithmic trading as opposed to the high-frequency trading.
Okay. Richard, let me throw this one out to you. Why is speed important to a trading firm, and do we really need to trade in sub-second intervals?
Thanks, Jim. That's a good question. I think, from my perspective, the most important thing about speed in a trading environment is how speed impacts risk management. Really, if you are trading in a particular way to be able to execute your trade very quickly, or to be able to adjust a quote that you have outstanding in the market, provides more certainty. And the more certainty you have, that means the less risk you have. The less risk you have, means that you're able to quote and trade in more, I think, valuable ways to the market ultimately. Meaning if you've got a resting order and you can adjust it more quickly, you can probably afford to have a larger resting order in the market. And you can probably afford to have that market maybe with a bit of a tighter spread than you would otherwise. And if you're looking to use a marketable order at a particular time, that certainty really means that you can arbitrage away inefficiencies in the market with more certainty than you otherwise couldn't be able to get to, and therefore provide, better pricing. And so to me, what speed does, and I think it's that's sort of a theoretical answer, it's really backed up by the empirical data. If you look at the studies that a number of people here in this room have done, as markets have gotten faster, there's a lot of evidence that leads to more efficient pricing, more liquidity, better market quality overall.
Anyone want to add to that? Amy, let me direct this one to you. And about cancel and replace orders, we've certainly have heard a lot from a number of regulators, including the chair of the SEC, about concern about the number of orders that are canceled. First of all, why do firms cancel and replace orders so frequently, and should there be restrictions on order cancellations? And I guess the follow-up to that would be, who's in the best position to do this? Would it be the exchanges or regulators?
It's a complex question.
Sorry.
Well, I think the cancel and replace primarily comes from the types of strategies, and that you see the cancellation and the replacement as a function of the strategy. And the market changes, the strategy changes, you get an execution, you cancel a lot. So you do see a lot of orders per cancellation, or a lot of orders per transaction. I think, is that a problem in the market? Well, I think there's certain bandwidth issues, and the markets have only so much capacity, and a lot of that capacity is driven by message traffic, and cancel and replace drives a lot of the message traffic. I think I'm not sure, I can't say anything about regulatory responses too much, but I do know that right now there's a few exchanges out there that do want to try their hand at trying to control for message traffic, or at least try to cover their costs due to message traffic a little bit better. NASDAQ, I'll pick on Frank, has filed with the commission a rule that would increase the fees to, is it firms? Is it members, or is it lines? Something like that. It'll increase the fees essentially to firms that have high cancellation rate, or not high message traffic to trade ratios. I believe it's 100 to 1. So if you have a message traffic ratio of 100 to 1, then you're going to pay higher fees or receive lower rebates than other firms. And so it'd be interesting to see, I guess, how that plays out, and whether all exchanges are ultimately going to go in that direction, or whether we'll see some kind of competitive response coming out of there, and what impact that'll have on high frequency trading, and perhaps that's the market solution.
Dean, this sounds like right up your alley. What's the CME Group's view on this?
Yeah, I think there's a couple things. One, there's nothing fundamentally bad about canceling orders. And, people look in the context of high frequency trading. And I think what people need to do is put a picture in their head of, the markets that, we used to operate in. I'd have a pit with 500 traders in there, all, 3-bid 4, right? All their hands are up in the air at a given time. So, you've got thousands of bids and offers, right? And they're being placed and canceled. The market moves. They're now 4-bid at 5. They're 5-bid at 6, right? Somebody's hands go up. Somebody's hands go down, right? Effectively, all that's happening in the electronic environment and with high-frequency traders is that's happening. It's just happening on the time scale, right, that we're dealing with in today's market environment. So from the CME Group's perspective, we certainly want responsible messaging, right, that promotes liquid markets and efficient markets. It's not really so much an issue for us with the technological infrastructures that we have today that it's a concern about bandwidth. It's really a concern about, the overall market quality that, that we provide to our customers. And part of that issue, too, is that, there are some exchanges who will say, okay, well, we're going to reward, bids and offers that are at the top of the book as opposed to those that, are away from the top of the book. And somebody can make an argument that, okay, the bids and offers closer to the top of the book are better quality, more actionable bids and offers, but you have to be very careful about what it is that you're trying to do, because certainly bids and offers away from the book, away from the top of the book, when you get into volatile market situations, right, you need that depth deeper in the book. Those bids and offers that are 15 ticks down in the marketplace are going to become the best bid in the offer in a millisecond, and that's how quick the markets move. So you want to encourage responsible messaging that is promoting liquidity, but there's a balance there. And certainly for us, we see certain market participants who don't have what we consider to be efficient or, responsible messaging practices. And generally, the reason that that's the case is not because there's any, anything fundamentally bad. They're not trying to deny access to the system. I mean, they just haven't fine-tuned their algorithm well enough, and so we work with them to get those in line. And we do have situations for each of our products, because each product is different. Our product benchmark in the E-minis, say, is 5 orders to every 1 contract traded. If we're talking about the soybean market, it's 55 orders to every 1 contract traded. Right? There's different dynamics that you have in different markets, and so you have to be flexible in terms of what you're trying to accomplish from a market quality standpoint in each of those different markets.
When did the CME group first adopt a trade to order policy?
2006.
Okay. Richard, you?
Yeah, I can add to it. I mean, I think this is something that we've been supportive of for a long time, efficient messaging policies from the exchanges that really try and make sure that we get a higher proportion of valuable messages that contribute to liquidity and price discovery rather than wasteful messages, I think are very desirable. There are benefits clearly to messaging. I think more messaging allows more price precision and allows, again, improved market quality, but there are bounds on that. And at some point, the externalities that come from having to handle massive amounts of data probably overwhelm the incremental margin of yet another message in a particular topic. So this is an important area that the exchanges have been managing for many years. Just as a quick story, back in 2002, we were one of the more active traders on the island ECN. And they had some problem in their system architecture where they ran out of trades on a particular busy day until they could get an upgrade done. They had only a certain number of bits assigned to their message fields. And the way they were managing that problem is they would start calling late in the day on a busy day when they thought they might run out. They'd start going down the list of people and say, okay, who's sending the most messages today? And when we get those calls, we would say, okay, we'll shut a bunch of stuff up. It meant that we traded less.
Yeah.
And it meant that we probably provided less liquidity and improved price discovery less and did all those things that are generally desirable. But I think most of the market participants want to be good citizens, want to be good participants. They want to understand what the guidelines are and follow them in a way that allows for sort of good competition and healthy competition in the markets.
I think both Richard and Dean's stories really illustrate the fact that the exchanges are probably in the best position to do this, and it should be market-based solutions. Obviously, it has an impact on everyone in terms of the regulatory fees with all the data being produced, everything that has to be studied. So I understand why regulators want to get involved in this. People, when you talk to the SEC or the CFTC, rightly so, they say, well, show me data, and we're in a room full of academics as well. That's great because there are 2 examples out there right now. We have Australia and Canada that have message traffic fees or regulatory fees based on that, and there's both, I think, qualitative and quantitative data you can get from that in terms of how that's working. It's new, but relatively new, but that's something, and of course we have some examples in the US as well outside of the equities side of things. But it is interesting in terms of other anecdotes. The problem has been early on, like let's say at the NYSE, they had excessive message traffic fees, and they basically ended up getting rid of them because the HFTs said, well, okay, we won't trade here then if you're going to penalize us and we can't make money because you're charging us an exorbitant amount. So they had to end up rescinding those fees. But I think at the end of the day, it's also pushed them to get better capacity systems and work on that. And I think there is generally a dialogue, and it tends not to be overall a huge problem. I think the bigger problems we have are, and Jim's written about this and talked about this a lot, are these systemic risk issues when things go haywire. I don't think it's usually the responsible, proprietary trading companies that end up with these huge problems, at least from what I know. They're very concerned about the integrity of the system. I think it's going to be sort of, I don't want to say 2 people in a garage, but people who maybe don't have as much invested, hundreds of people and tens of millions, hundreds of millions of dollars. So that's where I worry about it more. But I think overall, I'd rather see market solutions on this.
how does the speed of order entry and trade execution affect long-term investors? And related to this, has high-frequency trading scared away retail investors? Joe, maybe, I know you've spoken on this before, maybe you'd like to chime in.
Yeah, well, I think about the Facebook example most recently because, like a lot of other boogeymen that are out there, market structure becomes one and high-frequency trading becomes one. But the Facebook example, where certainly there were some problems with the opening cross, and I think that gets exacerbated by the fragmented markets we have, the cancellations, the need for speed. But at the end of the day, if I think what would affect retail investors post-Facebook, it's the fact that the thing is trading down massively. It's the speculation that certain information was available to the underwriters and institutional investors that wasn't available to retail investors. So I tend to, even though I'm a market structure geek and I love this stuff and it'd be great to really maybe have ideas and things that could shape policy that could help capital formation in our country, at the end of the day, I think a large part of the market, the biggest part of the market structure revolution is over. Overall, things work pretty well. And when we look at problems in the equities markets and why isn't retail interested, it tends to be fundamental economics, things like the European situation. It tends to be a decade or so of zero returns in the equity markets. It tends to be that the U.S. is still very powerful economically, but emerging countries have much greater growth profiles and have more mature capital markets than they had 10, 20 years ago. So I tend to think that these fundamental factors and these things outside of market microstructure, the micro being key here, are the bigger drivers. I'm not saying that things like a flash crash don't affect retail confidence, but I think they've been hit in the face with much worse than the flash crash, and the remedial measures that have been taken generally have, in my opinion, have worked, and overall the markets work pretty well in terms of whether it's the immediacy of trading or, as Richard was referring to, the statistics that you do see out there. I don't see much that's suggesting things are worse, and at the end of the day, what we look at most is the cost to institutional investors. We could look at other measures like spreads and all those effective spreads. Those all look pretty good too in general, but institutional costs, whether you look at the post-decimalization period when high-frequency trading actually started to penetrate the NASDAQ names, came down in NASDAQ-listed names, and then in 2006, post-Reg MS, when the same HFT revolution kind of came to the New York names, again, transactions costs improved the end results for institutional investors. I'm not talking spreads or any other metrics. I'm saying the end results were better. Post-2008 and the financial crisis, spreads and transactions costs went up, but again, that was driven by a massive financial crisis. So I think, I don't want to minimize it, but I think people are looking for boogeymen and saying, oh, we're scaring away retail and we're going to hurt our capital markets and the capital formation process, and we have to be very mindful of that, because that is the secondary markets. That's what we have to be worried about with respect to them. How are they affecting capital formation? But I don't think that's the big issue, to be honest.
And I think if you go to the retail investors and the ones who actually would say, yeah, I'm scared of high frequency trading, I think you have to dive deeper into what they're scared of. Are they scared of the actual behavior that is expressed within the market by high frequency traders, or are they actually being scared by, which, and I know I might come across a bit biased here, but frankly has been a very irresponsible press with reporting what high frequency trading is and how it works. And when you open up the newspaper and all you see is, I go back to, it's about 3 years ago, there was a case in the Wall Street Journal on the front page of their market section, wrote an article about a company that had been fined for creating high-frequency trading algorithms to manipulate other traders. And then 3 days later, 5 pages into the market section with a little gray box at the bottom right, and it was, correction, it was a hand trader manipulating high-frequency traders. But that wasn't the front page article. And so when you have instances like that, people who are scared might not actually be scared of what's actually occurring. They're scared of the shadows that are that are thrown about and caused by what is, even if the reporting itself isn't ill-informed, the brevity of the story and the information in the story can lead to an ill-informed public.
Peter, I just want to add to that because it's a great point. And what is retail today is one of the questions that we often sort of parrot back to people, which is, first of all, the average retail investor is really getting their exposure through mutual funds, through pension funds, et cetera. The retail investors today, I got to tell you, are not mom and pops. They're day traders, okay? Back in 2008, 2009, when everyone was getting hyped up on high-frequency trading, I had been studying it for about 8 years because I was lucky enough to have a friend that worked at GetGo, so I learned a lot. And around that time, though, I was starting, people were telling me about these day trading firms, and I was like, what? Didn't that go out with the internet? Wasn't that a 2001 thing? And they're like, no, there's this firm Swift in Canada. They have 4,000 day traders. I was like, what? So then I'm like investigating that and seeing that there's also a bunch in this country, and they outsource. It's actually fascinating in that they outsource to China and Russia because someone with their eyes and hands can make $500 a week by seeing mispriced quotes and things and take advantage of automated market makers and systemized trading out there. And of course that wouldn't make sense for a lot of people in the US. It might not be a big enough living for certain people, so it's outsourced, and there's thousands of traders in China and Russia that look at screens to try to pick off bad quotes and things like that, which I thought was fascinating. But that, as you said, and Swift is an example of a firm that actually got in a load of trouble both on Canada as well as in the UK. So I tend to believe that more of the manipulative behavior is taking place by hand or by sight. That's just, on what I've observed. But it's a great point, though, on where the hype is.
We've heard proposals, particularly in Europe, for time and effect rules for quotes. That is minimum quote life for an order before it's canceled. Is this a good idea? Maybe Peter, is this one you'd like to take on?
Yeah, sure. No. No, but the reason I think it's not a good idea is so much of what we've been dealing with in market microstructure and regulatory recently has been systemic risk and the avoidance of systemic risk. And one of the things that I think helps us avoid systemic risk the most is a very diversified marketplace, meaning many, many participants in the market for many, many different reasons. And minimum quote life, Richard talked earlier about how the ability to cancel your order and to control your order is a very large reducer of risk for an individual trader or for a firm. It's that on a system-wide level as well. Because if I'm forced to keep my order out there through an artificial time limit, and I oftentimes ask, does this mean we're going to delay news by that artificial time limit too? Hey, everybody who has an order out there, we're going to have some news coming up, so go ahead and put your cancel in as soon as it comes, because what's going to happen is the rest of the world will not be delayed. There will be no time and force for reality, only for what's in the markets. And so people who have their orders out there, information will have changed, and now they can't change to adapt to that information, which means they can be picked off, which means they have an abnormal amount of risk out there. And if this happens to a lot of firms, they won't come back and play tomorrow. If they're not making money, or if they're not making enough money to justify their existence, they won't be here. And so we could actually see, and this isn't leaping to grandiose conclusions, it could happen very quickly, that if there was a minimum quote life, you would see many less participants, not widen spreads, I mean less participants overall because of the amount of money they've lost through that minimum quote life. And when that happens, we have to ask ourselves how much more risky is the system of the markets because we have less players in the markets.
You'd have people build.
Can I call you on that? You said we could ask some questions.
Try.
Go ahead.
So you're advocating a system that was quite different from what we had in the days of hand signals and people stood in the pit. When you stand in the pit, you make a bid or an offer with your hand signals or something. It has to last long enough for someone to trade with you. And
So does every order I
Like a
place.
fraction of a second, maybe half a second or something like that. What you're suggesting is that you should be able to put in a quote and cancel it before, at the speed of light, somebody could get a message saying that your quote was there and respond to that message. So is that what you were saying?
No, actually, I think that there's a few things. When you hold your hand up and pull it back, busted trades came from the fact that you actually weren't liable. There were many, many traders that didn't end up having the fill because, well, I was in the process of canceling it. Or, their runner would find some way to lose the card. There's a variety of things that happen. But more importantly, every order I send to the exchange is actionable. Every single one. It doesn't matter if I place the order and a nanosecond later place the cancel, I could still get filled. It's actionable.
I understand that, but what you're saying is that you don't want to give someone else a chance to react to your order and hit it after they see it.
No,
The order is only actionable in the sense that if there's an order already there or an order on the way, they might incidentally execute against your order.
Yeah, that is
So
true.
you're saying that your order should not be alive long enough for someone who doesn't have an order in the market to see it and respond to it.
No, I actually personally think all of my orders should be out there. If I have to cancel it immediately afterwards, and it was a waste of my technical resources, and that's not what we invested in our system for. But I think that you get into the rabbit hole of what's that time period? What is the amount of time an order should be out there and allowed to be canceled?
Well, it's a minimum of 2 times the speed of light for how far somebody is away from the.
No,
supercomputer.
I know it should actually, it would have to be a little slower than that.
Yeah, no,
Because,
it's
yeah.
a minimum of that.
But it's but when you get to but you run into more issues, and I think you make very valid points, but none of those points are actually an argument for the benefit of slowing it down, for the benefit of having that guard. You're just saying it's possible. I'm saying, yeah, it's possible, you could do it, but I don't think you should for the reasons I stated.
Pete, there's also a couple points I would make, that if you have very wide spreads like you had back in the floor trading days on the stock market where it was a minimum of an eighth or a quarter or a half, you don't need to adjust your quote that frequently because you've got a big buffer built in there against the adverse selection of getting picked off. So if you want really narrow spreads and continuous markets, I think you do need to be able to have that flexibility to adjust those quotes much more frequently. The other point that I would make, though, is that if someone has a strategy where all they're doing is submitting orders and very quickly pulling them back before anyone can respond to them, there's something wrong with that strategy. There's probably a real big problem with that strategy. That's not at all what I'm advocating. What I'm advocating is that people should have the flexibility to adjust their orders very quickly in different situations where it's important to them. But I think a typical situation that would be, I've got 100 orders out there. One of them, maybe 1 out of 100, I've got to adjust before someone can respond to it, or 1 out of 1,000. But the risk on those is such that it allows, the risk mitigation of the value of being able to do that is such that my other 999 orders can be larger, or they can be, based on a tighter spread. And so what's not important is what's going on with the orders that are being canceled as much as what the flexibility to adjust an order gives you in terms of your ability to quote overall.
And there are markets with minimum quote lives out there. And I actually have never seen an actual academic comparison of those because I just haven't done it. But
Which markets?
There's
Or exchange.
thanks. Yeah, there's some FX. Yeah,
EBS metals.
EBS, yeah, EBS metals, EBS World Exchange.
It's not a lot.
Yeah, there's not many, and the reason. But what's interesting is if you talk to the people. So I've talked to some of the people at the EBS that focus on their market microstructure, and they're actually not convinced it helps them at all. And these are people that deal with it on a daily basis, and they're not convinced it helps them. I think that you could put in a minimum quote life. I'm not saying it's not possible. I'm not saying there's not some benefit to it. I think that the lack of benefit, because the benefit would be to control the people that all they're doing is placing cancel, placing
Well,
cancel, placing cancel.
if you did that, you just have people building algorithms to
Right.
take advantage of the people who are stuck in this minimum
Right.
quote state, right? And, I think your point about, what's going to happen to markets, particularly in volatile times, a lot of our concern is about how these markets react in time periods of stress. If I've got a minimum quote life that I have to deal with in a period of stress, I can guarantee you that my quote's going to be either really wide or it's not going to be there at all. And I think to your earlier point, if you're talking about people who are initiating orders and canceling them, consistently within a nanosecond, from a regulatory perspective, we're going to look at that from the standpoint of, does this look to be manipulative conduct? What is the objective of the party who's entering and canceling that order, right? So I think that the tools for regulators are there, so that can certainly be managed, but I think establishing a restrictive minimum quote life is a very wrong way to go.
Dean, on the other hand, there is the pause that you had, the pause mechanism that you have, the stop logic functionality does seem to have to play some role. You know, it applies to everything that's out there, everything is paused, right? So is there anything sort of in between that you're seeing, between maybe sort of the pause and the minimum code level? Because they're sort of driven by the same idea.
I don't think that they're driven by the same idea. I think that the pause, the stop logic pause that Andre's referring to is, you know, it's basically a tool that CME developed a number of years ago based on our experiences in the marketplace, that when there was this transitory liquidity gap, our match engine would automatically pause for a period of 5 to 20 seconds to allow liquidity to come into the market and avoid you know, an otherwise kind of inappropriate move in the marketplace. You know, in 2011, I think that we had 117 stop logic events that occurred. So, you know, 117 situations where there were these transitory liquidity gaps. The match engine steps in and prevents a larger problem or a disruptive problem from happening. But I think that, you know, there's certainly risk and volatility mitigation tools like that. We have a number of other tools, whether they're protection points for market orders and stop orders or price banding, credit controls. There's a whole host of things that you can do that I think are more efficient from a market perspective than, you know, trying to set this, you know, one-size-fits-all approach that every quote has to be active irrespective of the market conditions for a particular period of time.
Can I just pick up on that point too? Because it seems that every conference or every debate around high frequency trading always seems to get back to these same three questions, right? Time in force, cancellation ratios, and should we have some sort of speed governor on trades? And
Or should we just shoot them all?
Or you know, and to pick up on Joe's point, I'm with Knight Capital Group, and yes, we do employ high frequency trading strategies, so I agree with him on that. I disagree. I think we actually do it better than Gecko, but with that aside, we always seem to talk about these three issues, and we start talking about, you know, proposed solutions, or who should be the regulator and whatnot. But one thing that seems to avoid almost every one of these types of debates is what's the problem that we're seeking to solve, right? Well, what is the issue that we are trying to address, either through a better understanding of high frequency trading, however you want to define that, or some of these other issues around speeds and cancellation ratios. And so far, the only issue or potential problem we heard about, Amy briefly mentioned, right, deals with bandwidth, and do the exchanges have the bandwidth and the market have the bandwidth to process these. However, you never heard the exchanges having complained yet, as far as I know, and Frank could certainly talk about that, about their ability to process cancellations, order cancellations, or the frequency of trading as it continues to grow. So, and I think, Dean, I completely agree with you that, you know, to the extent that there's manipulation going on, either through these cancellations or the speed of trading that's designed nothing to do but to manipulate the market, I think the SROs and the exchanges do an effective job of policing that. But I guess the question for the panel is, you know, what do you think the problem is that we're seeking to solve? Is this simply a perception issue that we're trying to deal with? And I would certainly caution against, you know, regulatory fiat designed to address perception in the market, or is there some other bigger problem that we're trying to solve?
And Len, that's a great question. I mean, for me, it comes down to market quality. That's what we should be trying to solve for. I don't know that all of these proposals really do that. And, you know, we all could sit here, this is the great conference, to talk about what market quality means and what we're really trying to get at with that. But they're well-established metrics of liquidity. They're well-established metrics of volatility. They're well-established metrics of, you know, lots of features of market quality. I think that's what we should be solving for. Some of these may have an impact on it. I think it's worth studying. And I also want to note that, you know, for example, a minimum resting time, I think it's a terrible idea, but there's not a lot of empirical studies of that, as we've talked about. So I don't think there's anything in U.S. regulation that would prevent someone from experimenting with it. My guess is they wouldn't gain very much market share because that's not how the market wants to trade. That's not how they want to manage risk. and that's not how they want to be able to access the market. But I think anyone would be free to experiment with a model like that, and we could then gather some evidence of whether it worked or not.
I think NASDAQ did, I think you made a proposal on PSX, I think, to
It's not
experiment.
minimum resting life, it's essentially a speed bump on incoming orders. It's not a minimum resting life for both orders.
Okay. I would also say, by the way, I think the way Dean summed it up, the speed bump type things make a lot of sense in the equities world. The parallel on the New York Stock Exchange was the LRPs, which actually there weren't busted trades on the NYSE during the flash crash because they stopped trading. I think there's, with our fragmented markets, things get a little screwed up because instead of that being an alert to everyone, okay, maybe there's a problem here, the answer is you can go around that market. I actually think those were best execution violations. I don't know why they weren't pursued. I don't know if a market is slowing down for a reason. People better have a good reason for going around it. But in terms of minimum time in force, even though we're an institutional trader, I don't support any minimum type in force because I do think spreads would widen out. I don't think we have anything to replace it. The market making of yesteryear is gone, and this is how markets are made now. And I think it would result in worse outcomes for investors, even though, again, we're doing it by hand. We're trading by hand. We're looking at the screens. Things are fleeting, and you have to adjust strategies accordingly. The only time I get concerned is when it is manipulation, spoofing, whatever, and as long as that's being monitored properly and being dealt with through enforcement, I'm fine with people having fleeting orders that, I can spend more money and colo and do these things. The market making is a hell of a lot more democratic than it was 10, 15 years ago on the New York Stock Exchange. If your name was LeBranch or Kellogg, you could be a specialist and you were in control of IBM or whatever stock it was. Today there are hundreds of people beating the hell out of one another to make the best market. To me, that's a good marketplace. Regulators have to step in when there are problems. We have to worry about systemic risk. I also think, to your point, what are we trying to solve for? I do think there's a problem in small cap land. I do think, even if you look at the NYSE study from a few years back, looking at the outcomes in anything outside of the NYSE 100 and the NASDAQ 100, spreads didn't improve post-Reg and MS. You would have thought they would have across the board. They actually got worse when you, at least the higher volatility levels, all but the lowest volatility levels. So I think small caps are an issue, and we need to look at that, and Jobs Act I think is an incremental positive there. But overall, the markets work, I think, pretty efficiently, and I think doing something, an experiment would be fine, but doing something dramatic on minimum quote life, I think could prove a huge disaster.
Yeah, and I would just say, I think that, from my perspective, the problem that we need to be most concerned about in the era that we live in today, where we're talking about microseconds, is really the issue around market instability, right? I mean, it's really about testing, controls, supervision. Andre pointed out, situations where, we certainly have had. Sometimes it's high-frequency shops. Sometimes, it's other, non-high frequency automated shops that, have algorithms that run awry, and we know that we can conceive of a situation where that is extremely problematic and undermines the confidence of market participants in a way that's really detrimental. So if we're focusing our resources in thinking about where the real risks are, to me, that's the most significant one.
You mentioned algorithms going awry. Let me bring up this question. Amy, maybe you want to take this one on. A number of critics of high-frequency trading expressed concern about the runaway algorithm. And at least one prominent regulator in Washington has called for a regulatory requirement for the testing of algorithms before they're used in the market. Are runaway algorithms a concern? What kind of controls are in place or could be in place, and is regulatory testing a good idea?
I guess so. The first question on runaway algorithms, or algos gone wild is another way of putting it. is that I recently saw the results of a survey done by another regulator on high-frequency firms, and they found that 2/3 of high-frequency firms have experienced a runaway algorithm at some point in time. So it's not that isolated, that algo firms see this. And I think it's a real risk to them, and I think a lot of algorithmic firms recognize it as a risk and have risk management in place. Now, risk management in the overall market, I guess, is a different question. An individual algorithmic firm may try to manage their own risk, but they also may pose some risks on the rest of the market with their runaway algorithms. And so if their risk metrics or if their management isn't great, there could be externalities. And so one thing to think about is, where should the real risk management lie, and whose responsibility is it to take that on? And I think when we were in a world, I guess just 1 year ago, the world we were facing was you had different people in the market pointing fingers at everybody else. You're the one who's supposed to do the risk management. No, you are. And one of the situations that you had is that a broker-dealer firm or a non-broker-dealer could be leasing a line from a broker-dealer directly to an exchange, and there were no risk controls on anything being sent by that firm into the exchange. So that was possible 1 year ago. So if that firm had an algorithm gone wild, that could have had huge implications. Today it's a little bit different. There was a regulation passed a year ago that went into effect within the last year called sponsored access or market access rules. And that placed the responsibility on the broker-dealer who's providing the lines into the exchanges. So the members of the exchanges have a responsibility to do pre-trade controls on every order being sent into the exchange. So every single order from every client that they're offering lines to, whether it's a direct line or if it's going through the broker-dealer, requires pre-trade controls, and that's on those controls are based on creditworthiness and other factors of the client itself. And so I think, today we're in a little bit different world than we were a year ago, but there's still a lot of people who question whether that's enough. And I guess, one question that I'd have for the rest of the panel is whether they see any differences as a result of that.
I would say that I don't see a lot of differences in my firm directly as a result of those rules, although that there were rules that we're supportive of that I think are good. But I think an important thing to keep in mind is, as you pointed out, the first layer of risk that is borne by these trading would be on our firm. So we are already very motivated to make sure that we're managing risk as best as we can. There's no way to outlaw software bugs. There's no way to outlaw human mistakes, but you can, as Dean pointed out, have testing and processes and supervision and the type of controls that help to minimize those. And then you do it at multiple levels. And I think the FIA's Principal Traders Group, they put out some recommendations recently, and I think the CFTC actually had a subcommittee to the Technology Advisory Committee that put out similar recommendations that said that risk management needs to be on the firm, at the firm level, at the clearing firm or the broker level, and at the exchange level. I think that makes sense. I think it's important to mitigate the risk as best we can at multiple levels. And that seems to have been largely effective. While it's not surprising to me that maybe 2/3 of firms would admit to having some kind of software bug that they've shipped at some point, the fact that we don't regularly see major systemic risk from these, I think, is a testament to the fact that there is a multi-layered approach and that the incentives are mostly right in that area.
My guess is that the 1/3 were probably not telling the truth, so.
Yeah.
Yeah, I was going to say, little old Rosenblatt Securities, I remember an example, I hate to admit it, when we were on the floor of the stock exchange with our handheld and we had a new application that we had come up with for a particular client that does a lot of business. And, we took down a function of the exchange, our little firm, and we are far from high-frequency traders. So I think it happens to everyone. This is not a high-frequency trading problem. It's a market problem in terms of the fact that we've gone to technological solutions almost exclusively, and even the algorithms that I distinguished before from high-frequency trading, the fact is they can get into an endless loop as well. I mean, that's what you see. And if we look at the Facebook example, I'm pretty sure the way HFTs manage their risk, they weren't playing Facebook. They weren't responsible for taking Facebook down. There was, and then, sadly, we were part of the BATS IPO, but, these things happen, technological glitches happen, and I don't think they're a result of, one of my pet peeves is quote stuffing. There was another paper that just was released the other day about quote stuffing, and I got to tell you, everyone then goes to that paper and says, see, there's proof there's quote stuffing. And you read the paper, and it doesn't say that it's actually that there's quote stuffing. It says, more research needs to be done, etc. And then I look at the data set, and I see that almost all of the names that are proposed as evidence, potential evidence of it, are like names that don't trade very much. And I'm like, well, I know how high frequency guys trade. They're not trading these names. So something's going on in those names, don't get me wrong. There's definitely data bursts and all kinds of things happening, but there's a big difference between the reality of what's happening in the market and the problems that were happening, and the systemic risk that poses, and intentional quote stuffing, which was originally defined as someone trying to take down servers so they can slow everything else down and they can still trade fast. And when you talk to exchanges, how it works, you talk to HFTs, how it all works, and it seems like, again, a boogeyman to me. It doesn't mean that, again, we don't have this real problem with data and with the number of orders out there and technology and endless loops or errant algorithms or algos gone wild, whatever we want to call them. But that's a big difference between saying we have that problem, we need to solve it, and we need to cooperate to solve it, and saying that there are these evil people out there who are intentionally messing with systems. And that's my opinion on that.
Jim,
I should
oh, sorry.
I should ask a question because I'm the author of the paper, actually. So which paper you read? Actually, there are two papers about quote stuffing. One is open by me.
I read two of them, but one that just got a lot of press yesterday. There was one that was in about 5 different publications yesterday.
It's mine? Yeah. There's press coverage?
Yeah.
Yeah.
The press loves it,
I didn't know
give
that.
anything on quote stuffing.
That's okay, I'm real. So actually my paper's take actually is based on Rich's point. It's not evil, it's basically, it's externality. It's at how fast. I didn't say like high frequency traders are evil, but what I said is like, you said like if there's increasing speed, right? There's increasing liquidity. But people are trying to trade faster and faster. Is there a limit of the speed? How speed can benefit the market, right? So in my data, I find actually it's nanoseconds conservation. So should we even reduce that to even smaller increments? That generates lots of data. And also, I think the other thing is like, in terms of speed, think about minimum quote life. Actually, I think now the speed is like the relative speed matters. If we put minimum quote life, right, that affects everybody. So you always assume that, you post a minimum quote life, right? That affects me, but that also affects your competitors, right? It's the same. So my point is,
Sure, but it might affect all of them negatively. They may all widen their quotes because they can't manage the risk.
But they also subject to minimum quote life, all kinds of stuff.
No, I know, but if I want immediate liquidity, and again, let's go back to the retail investor that everyone's trying to protect. If quotes widen, they're obviously going to get worse outcomes.
I have another evidence. It's like, think about technology shock, right? There's natural experiments which somebody has a better trading technology. And I can find that in my data. At least after some stage, you cannot see spread become smaller when their speed goes faster. So when you reach some point, actually speed actually does not increase liquidity.
That may well be true. I'm more worried about regulation that may change the way things are done today. I'm not saying that, again, I don't spend an inordinate amount of money on getting co-located and all like that. We could do our trading without that function, but I do worry about the overall quality of the markets should we do things like minimum time in force.
Jim Angel, you got to...
Yeah, sort of two things. One, the problem with minimum time in force is that people who post liquidity will be picked off
by the sharpshooters who don't have any minimum speed bump to actually access the liquidity. But Joe, you mentioned data bursts, and I think that's a serious issue in market quality right now. And I'd like to ask the panelists, what do you think is causing these? Are these sloppy algos run amok? Are people just doing bandwidth testing when they shouldn't be? Are we seeing intentional quote stuffing? Are we seeing some other kinds of strategies that just happen to require a high level of cancel and replace? What is driving these data bursts?
Dean, it falls on you. You're the exchange.
Well, I do think that, again, in certain markets, you'll see what we refer to as microbursts at various points in time. Sometimes those are obviously event-driven issues, right? There's a news event that causes a burst of activity or something like that. And there are situations where we see it where you have an algorithm that has a problem, right? And in those cases, it needs to be addressed. We have not, I can say from our perspective, we have not found any situation where somebody is intentionally and successfully submitting quotes in a way that's designed to impact the availability of our match engine to fulfill its function. So that's not to say that it couldn't conceivably exist, but certainly it's a lot more difficult today with the infrastructure that we have than, say, it would have been 7 years ago.
Now, do you have safeguards in place that if somebody's algo has run amok and is giving you a data burst,
Right.
that you can sort of...
We actually have something called microburst volume controls, right? So basically what we do at the gateway to our match engine, if the volume of messages over a prescribed period of time exceeds a threshold, right, what it does in that situation is rejects those messages until you get back below the quote per time period threshold level. So again, that's there, but I think that my point to the gentleman earlier is we have to recognize the time frames that we're dealing with, right? A lot of stuff can happen in 50 milliseconds today, right? A lot of stuff can happen in 500 milliseconds, and that's a very short time. And so, the point that I was trying to make is, that we need to keep building, the granularity of those controls and the effectiveness of those controls to deal with the kind of environment that we have today.
Yeah, and your question, the cause of it, I think there's a lot of causes. I would be naive to think some of it isn't malicious. I'm sure somewhere out there someone has some sort of malicious intent and expresses that in the market from time to time. I think that there are poorly programmed algorithms out there. I mean, I'll give you an example of one that I'm happy to say I didn't program. But it said that it only wanted, and this is where you can get feedback loops in the market, which can cause these microbursts. So there was a program that said I never want to be more than 10% of the given size in the market. Now that is sensitive to other people placing and canceling orders. So now if somebody has but I want to be as much as I can, but I'll never be more than, so it's usually you're set to be 10% of the market in that case. But it's not, but if somebody else has a similar algorithm, maybe at a different threshold, and they and they pull an order, now you place, or maybe you pull, so now they can get back in, and you can get this fluttering action that goes on, this oscillation. Well, I'd venture to say that the vast majority of trading firms that have written an algorithm that says for resting the size they are, they run that for a day and they go, oh crap, it's like the thermostat in my house. I don't want to be 10%, but really I'm okay with 13 and 7. And then the very next day they change it. But I mean, these are things that, and there's no school that teaches you this. I mean, I know there's plenty of places out there that have, degrees in the markets, and even some of them are starting to look at the tech side. But really, there's no school where you go and they say, hey, now don't do it this way, do it this way. You've got to do it through practice, and you've got to do it from learning from the people around you. And so you'll see things like that a lot, and you can see these positive feedback loops in the market. I mean, there have been times where there's another, at the CME, there's another way that they keep you from microbursting, and it's a guy called Giuseppe. And anybody who's ever traded CME has probably dealt with Giuseppe at some point, because he calls you up and it's really frustrating, gets really angry, and it's great because it's like, because you just sit there and you take it and you're like, man, I really made him upset. And you never want to do it again. But he'll tell you about how you're putting too many messages into the market. And there's been times where he's called up, and I used to run our operations desk, so I fielded those calls. You know, I wasn't on the trade desk, but I was the first one to field those calls, and I'd find out what was happening, and we'd kill it. And there was once I was looking, he called me up, and I'm looking at him going, he's like, well, you're flashing this order. You know, you're flashing, and flashing is basically placing and canceling, maybe not so fast that someone can't interact with it, but it's really just placing and canceling at the same price, same size, over and over again. And I looked into it, and he said, you know, and it's not, and I know that sometimes you do it in reaction to someone else, but no one else in that product is doing it. So I started looking into it, digging into it, and we turned off our trade while we tried to figure out what was going on. And we were responding to someone in the equities market, because we were using an equities market to price our future. And someone out there was flashing. And
Probably
so,
pricing it off the futures market.
yeah, probably pricing off the futures. But I think this gets to a crucial thing that maybe is good for a conference on regulation, and that is, you know, Giuseppe didn't have a view of the equities market. The CFTC doesn't have a view of the equities market. You know, and so we really have to start keeping in mind that some of these things that might appear malicious are not. They are controlled as soon as they're found, they're removed, and the people that are overseeing these things, you know, I guarantee what did not come out of that conversation was the CME probably did not have a conversation with NASDAQ, which is where it was happening, and saying, man, you know what, our markets are really intertwined, we got to work on this. Now, we've fostered some of those conversations, and they happen in industry events like this, but it does come down to the fact that in order to properly try to ferret out what is happening, we need to look at everything. And that's not something that, yeah.
I was just going to say, the point that you're making seems to be exactly the reason that the type of sort of pre-regulation testing doesn't work, because it's the interaction of all these things together that's the problem, right?
Mm-hmm.
It seems the world that we're in, that we've moved to in technology, we're never going to get away from these programming glitches or these things that sort of interact with one another, which seems to me that this is exactly the reason that things like stop logic or the replenishment points or limit up, limit down, even the old volatility halts that I think they have in NASDAQ or order balance halts that they have on the NOC, that's what they're for, right? I mean, so you, to the extent that these things would cause a transitory flow of orders or an order imbalance, let's slow down a little and see if we can figure out if it's caused by something that we didn't really need to do.
But the great thing about the markets that we have, though, is that this audit trail exists. It's a complete permanent record of every trade, every quote in the market, and from the perspective of an exchange or a regulator, who sent it. And it's very easy to pick up the phone and say, hey, why'd you send that order? And I think that's what happens in the real world, and it actually is very effective, like we heard, you know, here from Peter. And, you know, when people often speculate, they look at the data in a vacuum, and they just spend hours and hours speculating on what might have caused it. It's frustrating to me, sort of like, you know, Joe's pet peeve on quote stuffing. I think, you know, you could pick up the phone and ask, and I can't pick up the phone and ask, but the SEC, the CFTC, the exchanges, they can pick up the phone and ask. I think that's a pretty effective mechanism. If they don't like the answers they get, there's an enforcement action. And so it seems like, you know, that audit trail gives us the power to make this a really well surveilled, very high integrity marketplace, and I think we're all looking for the same thing.
And you know, market participants will pick up the phone and ask too. And there's been plenty of times where I've called the operating desk at Globex and say, like, hey, what's going on here? Have you seen that these markets are just fluttering back and forth? Although is something's not right. And sometimes even to the detriment of my own profitability. I mean, like, I was watching the treasuries market one day, and it was clear that somebody just was messing up. They would lift the offer, and there was a pause for exactly 1,000 milliseconds. So exactly 1 second, then they'd hit the bid. Then they'd lift the offer, and they'd hit the bid. And I was top of book, and it's like, oh my God, this is fantastic. But at the same time, it's not right. Something's not going on. You know, something's going on that's wrong. Somebody is going to blow out if they keep doing this. So we called the exchange, and the exchange looked at it, and they called the person and turned it off. Yeah.
You didn't speed dial.
Well, I called the, I have got run down the street, knock on the door. Yeah.
So, Richard, you mentioned
Can I
earlier,
add
oh,
one?
sorry.
I just want to add one quick point. And that is that one of the things I'm frustrated by, one of the lessons from the flash crash, is that the futures market has a far superior audit trail than the equities or options markets.
Yeah.
Because no, the SEC cannot pick up the phone and figure out what's going on in the market within a day.
What about
You
us?
can call the exchange, you can
Yeah,
call
they could then
NASDAQ.
call, yeah.
NASDAQ would then call their members would then call their clients.
They're lawyers.
And
Clients
so
folks.
it's, I think, the process of getting the data in the equities and options markets is very different than in the futures markets, where futures markets really have it good.
Yeah, I'm not sure that it needs to be though, right? And we were talking about this earlier before the panel, right? I do think, and this goes to Peter's point, from my perspective, that's where, the broader federal regulators can add the most value. But I think that, it really has to come from, a commitment to figuring out how to employ the technology that actually does exist today, because it can be done, right? It just, that has to be the focus because, we obviously need the people and the expertise, and we need, the front-end systems to churn through all the data. But you can't do any of that unless you have the data to begin with, right? And, I think that just has to be, it's got to be a fundamental priority.
I think it raises the broader point that also a few people here I think discussed, is that trading has sped up a lot faster than risk management and then regulatory oversight. And that's, I think, what people are worried about a lot. And I think the measures that you're seeing is, let's slow down the trading so that risk management and the regulatory oversight could be somewhere on par with it. And you're complaining about it, you say, well, why would you want to slow down the trading? Instead, why don't you speed up risk management and regulatory compliance so it catches up with trading?
And just to be fair though, Andre, I think that, risk management has come an enormously long way over the last 5 years, as has, the compliance capabilities.
But trading is still faster, and it's a fact.
No,
Well, it
in our firm,
depends.
our risk management system is as fast, if not faster than the
Right.
trading system, because they work in interlock. I can't trade if my risk management system doesn't let me.
Right.
So it has to be as fast. Now, maybe,
You're not a high-frequency trader.
no, I would say we do high-frequency trading. In
Yeah.
fact, I think well, I know you don't count market making as high-frequency trading in some cases, but we do high-frequency trading that isn't just market making.
But, and I mean, we, many years ago, before, we got to the level of trade that we are today, right, we built an in-memory database that allows us to get and aggregate, 1 billion records a second, live, historical, right, on the analyst's desktop, right? So all that data is there. The systems can be built to deal with that data. But that's got to be the focus.
Let me provide a nuance there. I think that the regulatory risk management, and some of you alluded to that, to the two guys in the garage sort of thing. Two guys in the garage may not have the risk management, sophisticated risk management systems that some of you may have built. And so the risk management may not be uniformly cut up across the marketplace to the speed of trading, and the sort of regulatory analysis, if you will, of the data is not also uniformly cut out to the speed of trading.
I agree with you. I believe at every single point in the value chain, risk management can still improve, right? There is absolutely room for improvement, and I think that's, why, that's where my angst is, and, where my concern is, just because it can have such a dramatic impact on the market. And,
So
it's
some
not,
people say, high-frequency trading improves market quality. That's not the issue. High-frequency trading may improve the market quality, but the point is that if risk management is not uniformly cut up with it, and regulators are not uniformly comfortable with it, so what?
Well, Andre, I'm going to take the risk of disagreeing with the regulator, which is something I've always been told never to do. This is with the utmost respect and adoration. But I really think that the issue is not speed in risk management. The issue is process, it's control, and it's, you know, following good practices. I think there's no reason that you can't have a risk management system that's obviously done by a computer that can validate independently the fields in an order message as, you know, in sufficient time to keep up with the computer that's generating that. And I would say if someone's cutting out that last microsecond by skimping on risk management, you know, that's just terribly irresponsible. It doesn't have to do with the speed. The technology exists,
Right.
and the practice exists, the controls exist. You know, if people are using bad practices, they're using bad practices, but it's not a matter of waiting for risk management to get faster. Risk management is sufficiently fast to deal with all these problems if people follow good practices. And if people don't follow good practices, we've got backstops at the exchange level, at clearing firm levels, at other levels to prevent it from becoming a systemic problem, so that hopefully it's the firms that are skimping on risk management that, you know, bear the risk of doing so.
Right, too slow risk management is a conscientious investment decision. If people chose not to invest in their risk management platform, it's not that it's not possible. Because I could start listing off, and I take up the rest of the time, the number of checks that every single decision in my systems go through before an order message is even created, and then there's checks on that order message before it goes out the door. And no one at my firm said, no, we're too slow because of the risk management.
Yeah.
And if they did, we'd tell them, well, then come up with a strategy where you can be this slow, because you know what, like, we're doing our risk management.
Yeah, and I think those are great points, and whether it's, you know, market data or the order generation, the risk management, the fintech vendors out there are, you know, coming up with sub-5 microsecond, then it's, you know, it's the race, you know, then it's, oh, I can do it in 1 microsecond, and I can do 97 checks within that 1 microsecond. So, you know, Fixnetics is a vendor that NYSE Technologies invested in that, you know, claims to have, you know, microsecond speed on the risk check side of things, and there's a bunch of other vendors out there. So I think it's available, but I think it is, there may be people who skimp on checks. Again, I tend to think it's less the most sophisticated firms, because they are, you know, they have a lot of money at risk when they're doing this, and if they get blown out, you know, that gravy train is over. So
No,
I mean,
I do
made
give
this point that they had to close down the naked market access through regulation, not because people were just so wonderful and cared about their risk management. It just
well, I
wasn't.
mean, I would take issue with the approach that was taken. I think overall it's a good rule because it leveled the playing field, and that was to me the best result, and perhaps got rid of some bad apples. But in our case, we had a firm we were dealing with that, I got to tell you, you know, we're a 50-person broker-dealer, okay? These guys make a hell of a lot of money, and I know that they live, you know, they eat, sleep, and breathe their risk management, and I trust their risk management tools. So I wanted to be able to use their risk management tool, and fine, give me the keys, they can't access it anymore, but I thought the right result was let me use their risk management tool, and we couldn't. We had to use a third-party vendor or our own system. Well, I don't write risk management code for a living. I don't want to write it, and I don't want to pay a third-party vendor. So I think there was actually some bad decisions in that personally, but I think overall it was still a good market development in that I think we do have to worry about systemic risk, and there were people who were doing things that weren't right. But in our specific case, I would have preferred to, you know, I got guys like these, you know, to my right, they're in the business of risk management. So I trust their tools, frankly, more than I trust third-party vendors, and we don't write risk management code. So I'd rather use someone else's that is, their livelihood is dependent on it, and if I know them well enough and understand them well enough, and you know, this is a firm that I was dealing with that we had a 15-year relationship with. I didn't want to switch, use a new vendor, but I was forced to. I expressed it in person. I'm done writing comment letters.
And not
I get yelled at by anyone that the vendors then call me and say, oh, you're going off on vendors.
And maybe this is beating a dead horse, but there are participants that don't have the right risk checks. They've chosen not to, whether it's conscious or subconscious. But those people we should not have in the market. I mean, we should remove people that don't have a respect for the power of the market in the market. I just want to make sure we're not throwing out the baby with the bathwater. We don't want to say, well, high-frequency trading doesn't have proper risk checks because a few participants don't. I think we need to be clear that a probably vast majority of the volume and probably a vast majority of the messaging in high-frequency trading does have that, but there are those who don't. And We need to figure out who they are. We need to target that type of behavior and remove it.
I have a question for the panel, continuing on Amber and Amy, that basically say, we've got a gap here, but we don't have enough regulatory oversight. Maybe they haven't caught up to that speed. And of course, it's very expensive to invest in that regulatory oversight. And the question, what do you think is the best source of the money? Is securities transaction tax, that you guys who trade a lot will fund the regulators? Do you think there is an alternative source of money that you would suggest to take from?
Yeah, I'd sort of start with the premise, actually, but that it's a lot of money. And I know that, you know, the version that was out there of an SEC proposal initially threw out $4 billion to build a consolidated audit trail, and then $2 billion a year to be able to support it. And, you know, our response is, wow, we would stop trading and do that for much less. And, you know, so I think the real answer is it should be a consolidated audit trail. You know, if you don't require real time, if you're willing to accept overnight, and if you make some smart decisions about where you get your data from, and, you know, take your time in the industry solutions in terms of tagging, I think it could be done at a tiny fraction of that. Maybe, you know, single-digit millions of dollars to, you know, low tens of millions of dollars. And I think that's, you know, maybe you add some government inefficiency on top of that and, you know, build out the market. But I think that generally speaking, that's the order of magnitude in which this could be done. You know, my firm's a small firm. We archive data from 70 markets around the world. We can run queries on it. We don't have the benefit that a regulator has of having the attribution fields in that data. But in we're a small firm. We've made an investment over a small number of years to do something that's analogous to what we're talking about here, and we can accomplish it in a relatively small amount of money. And I imagine there's hundreds of firms who've done similar things already. So the technology exists, and I think it's a modest expense. You know, sort of pales in comparison to the overall budgets of the regulators and the like. It's a matter of making good decisions about how to do it.
I think, and some of it might be, God, you disagreed with the regulator. I'm getting ready to say some of them shouldn't have certain jobs. But I think some of it has to do with the people that are being hired, too. It does frighten me that there are very few, if any, engineers in regulation. We are a socio-technical system, and it is one of the most complex on the face of the planet. It is. Like, when there's serious issues that go wrong, some of the specialists in trying to figure out where they come from worked for NASA. You know, putting a man on the moon and the markets have like the same complication. So we need to have much, much more engineers. And I don't mean like another IT person to set up BlackBerries and laptops, because that is in the budget and they're asking for that. But I mean real, honest to God engineers who understand complex technical systems. That will go a long way. We really even shouldn't build out a surveillance system until those people have weighed in on what needs to be required.
The engineers to work for the CFTC, stand up.
Yeah.
Stand up, stand up.
Yeah. Yeah, and thank you. God bless you. But I bet just, you know, nod, shake your head. Vastly outnumbered by lawyers. Yeah. Not that there's something wrong with that. I think we need them as well to write the regulations and to enforce them and to figure out what's fair and what's not. But more engineers would be better. Like, let's give you guys 10 times what you have personnel-wise, and then like have you being able to start weighing in on whether or not a regulation should be written in a certain way because of your knowledge of the systems. That'd be fantastic, and we need to have more of it. And that would go a long way towards lowering the cost of building the systems to do the surveillance and the monitor.
And I think that's one of the positive things too about the self-regulatory model is that, you know, in the exchanges, you know, for instance, our market regulation group has the benefit of having all of CME Group's engineers who know, you know, the guts of the Globex system inside and out, right? How, you know, every thread works that goes into that system. You know, that's something that, you know, the federal regulators who don't operate an exchange aren't going to have the benefit of, you know, having that level of expertise and knowledge, you know, right there on site.
Okay, we're in the last few minutes here of our session. Let me throw out one last question and go down the line. Maybe Joe, you want to start with this. What things in your view have changed for the better or the worse over the last 15 years as a result of regulation, market structure, competitive changes?
Sure. I'd start with the democratization of market making that I mentioned earlier is a positive development. I also think the introduction of competition on the exchange front, through Reg ATS and other things, has lowered explicit costs dramatically. And then through a bunch of the other changes that we talked about, decimalization and development, automation, all these things have, I believe, overall lowered the cost of trading. So overall, I think it's a pretty good picture. I mean, I think you can take issues with specific metrics. I've been waiting, I haven't had a chance to talk to Richard, but they did a great paper looking at market metrics. And again, the ultimate one I look at is transaction cost. But a lot of the metrics are ones we all use, but one you had in there was available liquidity. And the question I've gotten actually from the SEC has asked me, well, are the metrics we use today the right metrics? Do we have to look at different metrics? And I think a couple of people's questions today hit on that. Now that we live in a microsecond world, are different metrics appropriate? And I think on that available liquidity metric that shows a great increase in available liquidity, I can take issue with it because I say, well, yeah, but when someone posts 100 shares in 13 different markets, and so you're showing 1,300 shares of available liquidity, you know as well as I do, when you try to take 1,300 shares across those different market centers, the chances of you getting anywhere near 1,300 shares is pretty light because of the risk management. And some even institutional algorithms have been built to deal with that. But we can talk offline about that. But I think it's a fair point to question some of the market metrics. But I do believe that overall that things are better. On the worst side of things, I think that, I already mentioned small caps, so I won't get into that. And then I think the thing that, Andre and others have focused on is systemic risk. Because on any given Tuesday, I have a great degree of confidence that our markets are better in terms of the results for investors, but I do worry about the systemic risks. And I also would say that the complexity that we have and the fragmentation and other aspects of the market have made broker conflicts, to me, really stand out. And I would love to see best, even as a broker, I would love to see best execution enforcement actions. But I think it's very difficult for someone to say what best X is in the world, the fragmented world we live in. When what is the NBBO at any given point in time? Never mind all the dark pools, and so how do you judge that? But I think some really bad behavior is happening by broker dealers. I actually think much worse than high frequency trading, to be honest with you. And that's something that I think has been aided by the complexity of the market. Maybe?
I think overall a lot of the changes in the market, and particularly automation and decimalization, have improved markets. I won't say anything about short selling, but I think generally those have been good things. I think some challenges going forward. One that hasn't been mentioned yet are how to deal with a lot of the outages that we see in the markets a lot. There's frequent data outages, frequent exchange outages, particularly during high stress times. And I think from a listing market sort of standpoint, perhaps there are disadvantages to an exchange going down at particular points in time from a listing standpoint, but do they suffer from a trading standpoint? Are they really internalizing all the costs of the outages that they face? I mean, Frank probably has a pretty good opinion of that, but one question is regulation required to solve the problem of outages in the market? Because the more automation we have, the more outages we see, and potentially the bigger impact those outages can have in the market beyond isolated incidents. I think there's lots of open questions out there on market maker obligations. That it'd be nice to see more research on whether we've gone too far away from market maker obligations right now, or whether we're in a good equilibrium. And actually, limit up, limit down, coming in next year will be an interesting issue to study as well.
I think from my perspective, obviously the markets are more transparent, they're more competitive, they're more fair, I think, than they've ever been. I think from a regulatory perspective, we have more precise more granular, more comprehensive audit trails and regulatory tools than we've ever had. So, and I think the markets obviously have evolved for the better in a whole host of different ways. I think the challenges for us going forward are, part of the issue has to do with fragmentation, but as the markets continue to evolve, in the space that I operate in the future space, those markets are becoming more competitive, more fragmented. We're going to have the OTC markets become more tradable markets as we go forward, so there's going to be additional related competitive venues. And at that point, we just have to make sure that folks can see across all those related markets in a way that allows them to effectively do the kind of effective regulation that's needed.
Thanks. So I won't try not to repeat too much of the things that I agree with that came out here, because I agree with everything that's been said. But I do want to emphasize that we spent most of this panel today talking about real extreme tail events. We talked about, different types of market manipulation, different types of risk management failures. And those are things that sort of, I'm pleased that the conversation has evolved in the direction of talking about those tail events that we all can agree something needs to be done about. I think that's a real positive development. I think generally speaking, there seems to be a growing consensus from the empirical data on the academic side, as well as from industry, that on average at least, market quality has improved a lot over the last 10, 15 years, and you can quibble over causation and, different areas there, and I think that's probably a lot of interesting papers to be written in that. But I think on average, and for most users at most times, market quality is vastly better in terms of the typical metrics that firms and academics and regulators use to measure those things. I think that's a huge win, and we shouldn't let our fixation on the tails make us forget about that. I would, on the outages point, I would disagree with Amy a little bit in that I think that back, it's actually gotten quite a bit better over the last few years. If you look back to the 2008 period of great volatility, we had outages at the exchange level, on a regular basis, 2 or 3 times a day at the peak of it, or maybe more at some times. And if you contrast that to the same volatility we had last August, where there were higher market volumes and similar volatility, we had almost no outages on the U.S. equity side of our markets that we experienced during that period. And in my mind, I think maybe it's the SEC putting pressure on exchanges, or maybe it's the experience of 2008 having really taught people, or the flash crash. But I think the exchanges have put a lot more effort behind the resiliency and durability of their systems. I think that's actually on display now in the most volatile time. So while it's something to be concerned about maybe relative to 10 or 15 years ago, I think we're actually moving in the right direction over the last 4 years or so. The complexity point is something that I would emphasize again. I think that while Reg NMS did some real good things to make the market better, in terms of forcing the market to become more competitive and more automated, there's a lot of rules there that, I don't want to always be the defender of the status quo, so this gives me an opportunity to complain about something. But, generally speaking, there's a lot of rules that I think are unnecessarily complex in Reg NMS and elsewhere that I think create systemic risk and may have contributed to events like the flash crash because of the uncertainty that those cause. I think that deserves a look. I think the complexity has gone up, and I think regulation is in part a factor in how that complexity has gone up. The other question about competition, I think competition has gotten much better over the last 15 years, and that's really resulted in better market quality. But I also see some signs in the last few years that competition may be going down a little bit or trending in the wrong direction. There are rules out there that raise the barriers to entry into our space that I think we need to be aware of, because I was able to get into the market with my firm in 2001 and compete against the incumbents, and my hope is that other firms will get there and give us a run for the money in the future. I think that's necessary for the markets to continue to evolve and improve, and I want to make sure that the regulation takes into account the competitive features of those rules as well. We talked a little bit earlier about unintended consequences, Chester spat in his speech, and I think competition should never be one of those that we hadn't thought about. We really should think about that when passing new rules, because I'm concerned that trend might reverse. I think the last point that I'll make, and I don't know if this is better or worse than it used to be, because I really wasn't in the market 15 years ago, but I think we've got this fixation on the equities markets, more so than any other markets. The equity markets, in my view, are the best and strongest, well-performing markets. Futures markets are pretty darn good too. But, we got this fixation with the equities markets that I think often leaves us not thinking about things like fixed income, for example. And so much of investors' portfolios are in fixed income. The transaction costs are still so high, the transparency is still so low, the competition in those markets is really weak. I don't know if that's a trend that I can really put my finger on, but I think it's something that we really need to think about, because we're again fixated on the tails of the best markets rather than really fixating on markets that could use a lot of improvement. So,
all right, I'll start with the negatives so we can end with positives. First, I think there's just, along with I think Reg NMS was good as well, but I think one of the end results is there's just too damn many equity endpoints. Like, I would love to scale it back. The cost is getting absurd to trade equities in a way that allows you to be compliant. And then, but actually the biggest negative, and this isn't over the last 15 years, I think it's more over the last couple of years. I think one of the big negatives that has come up out in the markets is legislative involvement in market microstructure. I like experts to do what experts do best, and we have some very good experts at the regulatory systems, both at the exchanges and at the federal level. And I don't like artificially imposed deadline. The best thing to happen to a deadline was to not hit it. I think those were all pretty good. But I think that having legislative and thus public opinion getting in the way of regulating the markets isn't a good thing. And we need to take a step back and let the experts do what the experts do. But now I agreed with all the other negatives and positives too, by the way, from the other panelists. But the positives, I think one of the biggest positives is the legibility of the markets. Why something happened is actually more evident than it ever was before. The fact that and it's not a fleeting transparency. It's not like somebody walking by my window and I'll never see it again. It's all recorded and it's legible and it's there, and we can go back and see everything that happened. And I think that gives us incredibly powerful tools to optimize for the future by learning from the past that we didn't always have with the marketplace. And this is a relatively new thing, and it's because of the technology advancements. And this lends itself to the biggest positive I see, which is resiliency. As much as our markets are complex and complex systems on top of complex systems, a lot of systems fail horribly. And our markets have had, knock on wood, the amazing ability to be resilient and to bounce back from what looks like impending doom to not be. And so I champion that resiliency. I think that shows that while there is a lot of risk in the markets and we still need to work to avoid systemic risk, we've done a pretty good job as a whole of making a resilient marketplace.
negative and positive.
All right, well, Paul, you want to give an announcement on what's next?
Yeah.
And let's thank our panelists. Okay, drinks start at the old Ebbett Grill in about a half hour, so I'll be very brief here. I can't thank you guys enough for taking time out of your schedules to come and talk to us. For given the amount of money that we have to work with, giving honorariums to people like this, it's pocket change. They forget to cash the checks. So we thought what you'd really want is Notre Dame coffee mugs. Hopefully, Amy doesn't get in trouble over this.
We don't regulate Notre
If you
Dame.
don't, and if you don't want to carry them with you, leave them here and pick them up tomorrow, or we'll mail them to you. The other thing, this may not appeal to everybody, but for those of you who would like the idea of getting up at 6:30 in the morning and running 5 miles, Mike Cicello over there, there's Mike, will be organizing a run from the lobby at 6:30 tomorrow morning, leaving promptly at 6:30. And see you all over at Ebbett Grill in a few minutes.
I might actually just
outside of Chicago more than in Chicago.